On Thursday, April 29th, the Commerce Department reported that America's first quarter GDP growth came in at a minus 1.4%, below economists' expectations of a positive 1%. This is the first negative print quarter since the COVID-induced flash recession in the second quarter of 2020. Is it time to panic and sell your equities and sit out because of a looming recession? I'm Chris Parrish, Chief Investment Officer with Oak Harvest Financial Group here in Houston, Texas, and this is our investment team's midweek release when we examine a news item, headline, or story making the rounds from publicly available sources, and we ask, is it news or is it noise? This week's topic is last week's headline news stories of a weak economy and negative GDP growth in the first quarter. First off, I will continue to remind investors that government data is reported late, it's often revised multiple times, and it's almost never predictive to the economy or stocks. Yes, the minus 1.4% decline is a sharp slowdown from the 6.9% gain in the fourth quarter of last year. The hurdle for real growth was almost impossible. The GDP price index rose by almost 8%. This means that the real GDP contraction of minus 1.4% was still a nominal GDP expansion of over 6.5%, which is insanely strong for a developed economy like the United States. While we were one of the early firms calling for a first half slowdown in the U.S. growth, there is almost no chance the economy shrunk last quarter, and this report does not change our expectations that the Federal Reserve will likely hike 50 basis points in May and another 50 in June, which should keep volatility elevated. Investors who do care about these government statistics should look behind the headline number to see what is really going on in the economy. The drop-off in first quarter GDP was led by a surge in imports, mostly delayed goods for Christmas, hitting our ports and our shores. Strangely, imports count as a subtraction or a negative component to the calculation for GDP. Imports jumped to a record high in March as the huge backlogs of ships containing goods at the Port of Los Angeles and other ports that were waiting at the end of 2021 were finally unloaded. The second area of weakness in the report was federal government spending, specifically defense spending, which was a carryover from President Biden's 2021 budget. Clearly, the recent Russian invasion of Ukraine will reverse that line item in coming quarters. While we continue to expect a normal summer slowdown ahead due to higher mortgage rates and fewer government handouts to consumers, personal consumption rose over 2.5% in the first quarter of 2022 due to our economy running at full employment levels. Moreover, fixed capital investment rose over 7% on top of the fourth quarter's 2.7% as companies have begun investing domestically in capability of reshoring some of the capacity that have been outsourced to foreign countries over the last 30 years. Is this story of negative GDP quarter news? Yes. Enough people follow and report on this data that we feel compelled to discuss it. Is it something our investment team worries about? No. We've been clear for the last 4 years. There is nothing predictive about government economic data. It is a signal of impending recession, not in our view. It's noise for your investment accounts. As we have tried to stress since last November, this should be a sloppy, choppy mess of the first 3 quarters of 2022. However, there should be some good short-term news in the weeks ahead. Tune into our Friday podcast, keeping you connected to your money to see what our team is thinking. Give us a call here to speak to an advisor. Let us help you craft a financial plan that meets your retirement goals and needs first and your greed second. Call us here at 877-896-0040. We're here to help you on your financial journey into and through your retirement years. I'm Chris Parrish, and from everyone here at Oak Harvest, have a great week.